Here, the first one is by Oliver Morrissey, University of Nottingham. It's on aid and exchange rate in Sub-Saharan Africa. No more Dutch diseases. I wanted to remove the question mark.
If you're convinced by the paper, you will.
Okay. Go ahead.
Okay. And it's kind of now for something completely different, because this is not about banking, it's not about finance, but it's a macro paper that's part of a component of the program that's looking more at international capital flows, and the particular focus here, as it says, is on aid. And the motivation is that there is a large literature which argues that aid has a Dutch disease effect, that a particular problem with aid is it leads to an appreciation of the real exchange rate. So the purpose of this paper is to ask the question, is that the case? I'll give you a brief outline of the paper so that anybody who's tired or stayed up late last night, you can rest your eyes after this slide. So as I mentioned, there is this theoretical model-based literature strongly associated with the IMF and often calibrated to particular countries, and that in general it predicts, yes, there'll be a real exchange rate appreciation, so there's a Dutch disease effect of aid. The existing empirical evidence is very mixed, and two particular problems with that evidence that I'll emphasize is, first of all, it uses a donor measure of aid, which tends to overstate the amount of aid actually received by the country, and it's the amount received by the country that the country's authorities know about that you would expect to have macroeconomic effects, at least on policy, because that's the measure they can react to. And also it uses annual data, and that imposes severe limitations on what you can do. To get around that problem, we use central bank data on a monthly frequency, and it's for 10 African countries over almost 17 years. Now, not all countries have data for all of the years. The 10 are chosen simply on data availability. So they're the 10 countries for which we could find monthly data on the variables of interest. We have a fairly simple structural VAR estimation, the same model applied to all of the countries, with two systems. One is a policy system, which tries to pick up variables that may react to the aid inflow, and the other is the outcome system, which looks at the effect of aid on the variables we expect it to affect, including the real exchange rate. The evidence: aid has a slight appreciation effect in the sense that the coefficient is in most cases positive, but in most cases it's insignificant. So it's a very weak effect, if there's any. And just as an aside, although I won't report the results, it's much weaker and much less important as a determinant of the real exchange rate than export commodity prices. So most of this theoretical literature, it's Keynesian or DSGE type models with a particular structure, frequently calibrated to a particular African country or a typical African country. And the advantage of the models is you can explore the effect of aid, or in particular aid surges, under a variety of scenarios. But nearly all of these scenarios predict appreciation, a Dutch disease effect, and often quite a significant effect. If there's full sterilization, that reduces but doesn't eliminate the effect. If there's no sterilization, the magnitude of the effect, it's typically positive, but it varies according to the scenario. It tends to be greater under pure floating exchange rate regimes. It's more moderate under fixed exchange rate regimes, and it tends to be lowest when you've got what's often referred to as a crawling peg or a dirty float. Now, arguably, in many of the African countries, they have a managed kind of float or a fixed exchange rate. So they will be the two main scenarios. It's also worth observing that in most of the theoretical literature, they would predict that there are circumstances when they say you could have depreciation. In particular, it's most likely when the aid is spent, so that it does have, it's fiscally spent, it's spent by the government, but it's not fully absorbed. It's not all used to finance imports. A more relevant or perhaps more interesting argument that there's one or two theoretical papers, in particular Chris Adam and David Bevan, who essentially argue that if aid finance investment increases productivity, that will mitigate or offset the Dutch disease potential. But most of the theoretical models don't incorporate that effect. And, one conclusion you could make is, well, perhaps that's why they end up predicting an appreciation, because they don't incorporate the channel that would counteract it. The empirical evidence is very mixed, and it's also limited for sub-Saharan African countries. Broadly speaking, they're most likely to find a significant appreciation in francophone countries which have a fixed exchange rate, either to the franc or to the euro now. But even there, it's perhaps only half of the countries where, in different studies, it's only about half of the countries where they find a significant effect. And very few countries with flexible exchange rates exhibit Dutch disease. It's very rare in those cases. So it's mixed, it's inconclusive, but there are two big problems. One big problem with the existing literature is it uses annual data. Now, there's two problems associated with that. One is that limits your time series. At best, you have 40 years, but in most of these studies, they've less than 40 years. Another related but more serious problem is that the exchange rate regime in particular, and the policy regimes, may be changing a lot over that period. In particular, the exchange rate regimes have changed. And if you've got a limited time series of observations and the regime is changing, it becomes very difficult to get robust estimates. The other problem is they tend to use, because it's the most easily available, a donor measure of aid. That restricts them to annual data, but it also overstates the amount of aid that's actually received in the country. And that may induce a bias. So there are two problems with the existing literature. So to get around that, what we do is we use monthly data, which is reported by central banks on the aid grants received. Now, one question of interest is, well, how does our measure, it's called here MRS, which it doesn't mean the marginal rate of anything. It's just that my co-author called it MRS because it's Morrissey, Roger, and Spreng. And Lionel Roger and Laura Spreng, the two co-authors who did the analysis, the econometrics, they did. But just to get a rough idea of how it compares to the annual data, we annualized it and compared it to other aid measures. And broadly speaking, it's quite similar to the DAC data on grants dispersed. So, overall, if we look at the kernel density, this is our one, and that's the DAC data. So they're quite similar. This is if they're expressed as ratios of GDP. Again, they're quite similar. But there are areas where there are significant differences. In particular, there are certain cases where our measure is much higher. There are other cases where our measure is lower. Now, in this table, just give these, I'm not going to go into this, but I do want to highlight, and in particular if anybody can offer an explanation, because I don't know why, but there are, on average, over time, over the years involved, and the countries, on average, our measure is almost the same as the measure of grants dispersed. And that's what we showed in the kernel density. But there are big differences for some countries. For Kenya and Mauritius, our measure is much higher than any of the DAC measures. It's even, in both cases, our measure of grants is even higher than World Bank data on net aid. And it should be lower. Oh, I don't know why. My only guess is that in both of these cases, there may be grants that they're receiving that are not from DAC countries. Perhaps it's an effect of China, or in Mauritius' case, it might be an effect of India, but I don't know. If anybody does know or have suggestions, I'd love to hear them. And there are other countries where our measure is remarkably lower than the others. There's something really strange about Ghana, because grants dispersed and grants committed, given the ratios, seem to appear to be higher than net aid or higher than country program aid. So there's something strange about some of the data for Ghana that we look into. And also for Burundi and Malawi in particular, our measure seems to be a lot lower than the DAC measures. So, on average, it's very similar, but for particular countries, there seem to be big differences between our measure and the DAC measures. And in particular, Burundi, Ghana, Kenya, Malawi, and Mauritius. Incidentally, since Martin and Thomas are here, we're almost spot on with Uganda for grants dispersed. Also for Lesotho, and Burkina Faso is very close as well. So it's interesting that there are differences. Okay, so what's our modeling framework? It's a straightforward structural VAR where we have a set of endogenous variables and a set of exogenous variables and dummies to allow for outliers in particular months. And then we estimate two systems. What we call the outcome system is to capture the impact of an aid flow on key macroeconomic variables. So that has aid, the domestic interest rate, which is the rate on the 3-month Treasury bills. We choose that. The reason we don't take a typical central bank rate is because in these countries, those rates don't change monthly. And sometimes there may be periods of time where the official rate or the basic bank rate doesn't change. But the Treasury bill rates tend to have more variability on a monthly basis, so it's a richer variable, more useful variable. We have the real exchange rate, which is again measured on a monthly basis, and the balance of trade. We incorporate, although don't discuss the results, we incorporate two exogenous variables. There's a price index of export commodities for the country and a Fed rate. So that's a standard kind of foreign interest rate. And then we have a policy system, which is to look at variables that might respond to aid as the central bank implements policies to respond to it. And those are reserves, government claims on the central bank, and the money supply, M2. We just use a standard Cholesky decomposition. That's the most simple approach. There are issues about the ordering of the variables, but our argument is, well, first of all, we're only concerned with the effect of aid. And because it's monthly data, it's reasonable to argue that the aid can be ordered first, because the other variables are very unlikely to affect aid on a monthly basis. On an annual basis, they could. This just shows that Malawi is our shortest span, but we've still got 90 observations. For Uganda and Kenya, they're the longest. We've got 187 observations. So with the monthly data, we've got good frequency. This is just to show you, look, we have tables of results. All I want to highlight is, to the extent you can see it, bold, anything in bold is indicating that it's significant at the, I think at the 5% level. And the point I want to make is there's very few. There's very few that are significant at the 5% level, particularly if we look at the real exchange rate. But Burkina Faso is one case where there is clear evidence of significant appreciation. A couple of other cases where maybe in one period, Uganda, you've got a significant depreciation effect. When we look at the policy framework, again, it's similar. There are more significant variables, but it's not consistent, and most often we might find an effect on reserves in some countries, an effect on claims. So, to summarize the results that's there, in 6 of the 10 countries, the coefficient on aid is positive. It's also positive in Kenya, but effectively it's 0. But it's only significant in 4 of those countries, and even for 3 of them, it's only in 1 of the periods. So Burkina Faso is the most consistently significant appreciation effect, and of course it's one of only 2 countries in the sample that has a fixed exchange rate. Lesotho is the other. Mauritius for 1 period, Ghana for 1 period, Tanzania. So weak evidence, fairly convincing evidence for Burkina Faso, weak evidence for Mauritius, Ghana, and Tanzania. So the inference, and you can get some of this by looking at the policy responses, is that the policy responses did not fully mitigate potential appreciation effects. And essentially what you tended to observe is a reduction in the central bank claims against the government without an increase in the money supply. That is the indicator of sterilization. So these results are consistent with flexible regimes, limited sterilization, and reserve accumulation, which is a scenario where you would expect an appreciation effect. But the appreciation effect we find, where we find it, is much weaker than the theoretical models under these scenarios would predict. Then for 3 other countries, there's no evidence of appreciation. There's a significant depreciation effect for Uganda. That's consistent with what you could call over-sterilization, that reserves and M2 both decreased. There was a deterioration in the trade deficit, which is kind of consistent with what you could say more than full absorption. So imports increased by more than you would expect. I just observed that this result for Uganda is consistent with one of the theoretical models that is calibrated to Uganda. And they also suggest that you'd have this combination of sterilization and spending in full that leads to depreciation. Malawi and Botswana, it's not significant, so I won't spend any time trying to interpret them. So what are the conclusions? Well, aid, on average, may be associated with appreciation, but it's rarely significant and it's very weak, which suggests that by and large these countries are implementing policies that accommodate the aid inflow, so there's no need to be concerned about the Dutch disease. It can happen, but even where it does, and it tends to be, in our case, really only when you've got a fixed exchange rate regime, it's a problem, but the problem is they're not accommodating it properly. And it might be a limitation imposed by the fixed exchange rate regime. For the other countries, they seem to be able to accommodate it. The aid tends to be associated with, some of it goes into increasing reserves, and certainly it's spent, so it reduces budget deficits. You can just observe that commodity price fluctuations, on average, dominate aid shocks. And so that they are twice as important in explaining variations in the real exchange rate as aid. Why, I suppose, final comment is, well, why might our empirical evidence be different from the theoretical or calibration evidence? One possibility is, well, we're wrong. They're right, we're wrong. That's always a possibility. And there is a literature, recent paper, kind of demonstrating that structural VARs are not very good at estimating monetary transmission compared to the DSGE. And they do it by setting up a DSGE model, generating the data, and then testing using a structural VAR. But the arguments, they say, is, well, the real problem is because you've got low-frequency data, annual, so the structural VAR doesn't work very well if you've got annual data, especially when there's large measurement error, in particular GDP, which is not a variable we include, and in particular when there are a number of shocks that are relatively large, which is more likely if you've got annual data than are looking at a shorter period where the exchange rate regime, at least, is pretty much stable in all of the countries. Another possibility is that, of course, we're right and the models are wrong because the models don't typically incorporate the theoretical mechanisms by which aid would offset any Dutch disease effect by increasing productivity. Or if there are unemployed resources in the economy, you won't necessarily have any Dutch disease effect. The models tend to assume a kind of a full employment, which is unlikely to be the case in most African countries. And another possibility, another relevant thing, is that the significance of the amount of aid that these countries are receiving is diminishing over time. So we're looking at a period where aid to GDP ratios, in particular grants to GDP ratios, are becoming much lower than they used to be in the past. So now it's still an important inflow, but the monetary implications are more easily, if not easily, accommodated. So there's no more Dutch disease. That's the end.
So you have answered with a yes to my question.
I can take away. I would take away the question mark, but referees may not.
Good. Three questions, and then we can go ahead. And then the third one over there.
Okay, thank you, Oliver, for that very interesting and pertinent paper. My concern really was with the frequency of the data. You've used monthly data, but I think that's potentially problematic because we would expect real appreciation and Dutch disease effects to take place when there is spending in the economy. But there's often very little correlation between the point at which aid is received in a country and when it's actually spent. Money can sit in bank accounts in the central bank for months after it's been received, in some cases years, in terms of project aid. So you wouldn't expect a clear impact on spending when in the month in which aid is actually being received. The other thing is you won't necessarily get an impact on reserves either because of the way central banks report their reserves. Generally they will not include the money, the foreign exchange they receive as aid in reserves until it's actually spent, until it's actually swapped into the domestic currency. And sold to the government, essentially, which can be also a long, long time after the aid has been received.
And last question over there.
Yeah, thank you. Hi, Oliver. Great paper. Very interesting. Two different types of questions. So one is a bit about the measure that you've used. Does it include only grants or also grant equivalents, and whether that, for example, includes transfers through development finance institutions such as CDC, which could be grant equivalent, and that could make quite a big difference to the data, particularly for countries like Mauritius and Kenya. Then in terms of the results, and they're of course very promising and very helpful for those that think about the impact of aid. Could it be that there is a sort of a selection bias in the types of countries that are included, that those countries that are able to publish monthly data are perhaps those that are a bit better managed and can manage the aid inflows a bit better as well. And I noticed that I think you've got one Francophone West African country in there, and if the literature is particularly on those countries where there's Dutch disease, I don't know how that would affect the results. And the other possibilities are perhaps that we're better at doing aid, that different types of aid have become more prevalent, more on productive capacities. And the final little point is around the point that you've made around the importance of policies. So you mentioned that perhaps countries have put in place policies to accommodate flows. Wouldn't you want to then also maybe put it as a variable in the model, some policy variable, and that maybe there are some differences across countries in terms of policy responses as well, and perhaps over time as well, but that those countries that have complementary actions to make use of aid or any type of flow, and that they have been able to use the aid to increase productivity. So maybe some sort of institutional variable or policy variable. Of course, it's a difficult debate there, but I think that might also may have an impact. But great paper.
Very good. Before you answer, can I add one other question about whether there could be any asymmetries in terms of the impact of aid on exchange rate, especially if you disentangle between effects on nominal exchange rate versus real exchange rate? Because I can imagine that for different reasons there may not be a negative effect when you have an increase in aid if it is well used, but we have seen that when there's a cut in aid, typically exchange rates do get affected. I can give you an example of my own country now, where we have seen a drastic cut in aid and the currency is very weak. So, go ahead.
Right, I can...
1 minute. You have 1 minute. I was just told by the super chair.
Thanks for all the comments. I've noted them down. Some, I can be clear, the data are differenced. We stick to the real exchange rate because that's what's in the literature, that's what's in the models. So, and then we want to be able to compare what we're doing to the models. What drives the real exchange rate itself is not what we're concerned about. That's an interesting issue to look at, and certainly you could do, to address particularly some of Dirk's kind of questions, Martin's issues of, well, it might take longer for these effects to come out, to appear. If we had data on spending on a monthly basis, we could address that. I did do some work with Thomas, did work on that where we did have monthly data on spending and aid, looking at the fiscal effects of aid, and that suggested that even with the monthly basis, we could find an effect that the aid was being spent. So, but for this analysis, we didn't have that data. What you would hope is that because of all of the lags in the system, and because the impulse responses are stretched over a number of years, that even if the effect takes time, we'd still find it. We might find some evidence of it. So there is, the estimation does allow for responses to occur up to 3 years, up to 36 months. So, we would hope that we might pick it up. But yes, the data, the methods always limit what you can do. And I do believe in being modest in the interpretations. I think your point about all we know is that it's grants as reported by the central bank, but it's quite likely, as you suggest, that perhaps what's included is not the same in every central bank. And I think the CDC and those type of things might be quite important for Mauritius, and that might be a reason why they might include that, and that's why we find it much higher than the other measures. So thanks for that suggestion. And I do agree that part of the less evidence of a Dutch disease may well be because, well, aid is being managed better. I would actually give the credit to the central banks rather than the donors.
Yeah.
Okay.
I know that. Yeah. Okay. Thank you very much.